Good evening and welcome to Habito's first landlord meetup of the year. We're delighted to be back with you, so I'm grateful for all of you spending some time and coming back to see us on this sunny evening. I hope you're well, keeping safe, and have a nice cool beverage beside you. Once again, we've got a packed agenda for you with a distinguished panel of guests and speakers to run through everything that you need to know about property, being a landlord, buy-to-let, and cutting through some of the myths and data that is out there in the market at the moment. So this is our running agenda that we're going to be covering today. I've set the speakers quite a tight time scale because I do want to make sure that we find time to answer all of your questions. We've got a panel event at the end where all participants will take part. So with that in mind, I know a couple of you have already submitted some questions ahead of the event, but I would encourage you using the Q&A button that's available on Zoom throughout the session, or immediately if you've got any burning questions, to submit your questions. And then what I'll promise to do is make sure I put those questions to the panel at the end in the session that we've set up. Obviously, there'll be things that the speakers talk to you about, and hopefully that will trigger some questions as we go along as well. So if I just move on to introducing our speakers, we've got Kate Faulkner. Many of you will know. Good evening, Kate. Kate is our resident property expert. So Kate, I know I'm looking forward to your session, talking us through the property market and lots of interesting data, no doubt. Also delighted to be joined by Dale Jannels, Managing Director of Impact Specialist Finance, well-established broker, packager and distributor in the market. So looking forward to your insight into the market, Dale. And then finally joined by Martijn, Habito's CFO and MD for lending. So Martijn will talk you through his insight and also some of the things that we're doing here at Habito. So just a reminder again, don't forget those Q&As as we go along. But Kate, shall I start by handing over to you?
Yes, that would be good. Are you running the slides? We've got to have
yeah, I can run the slides for you.
Talked about everything else before we came on, except something useful like that, didn't we?
Okay.
Right, so where next for the UK property market? Well, anybody who got a crystal ball out last year, as you'll see, had a little bit of a struggle. So we'll see how we get on now. So what I've done is just looked at economic situation, prices, rents, and kind of what to watch out for 2021. So just that kind of essential stuff that's worth having in your head when you're thinking of coming into the market, leaving the market, or whether you're looking at already in and you want to expand. So we get on to the next exciting slide. I think it says current economic situation. So just on to the next one. And this, you kind of have to just sit and stare at this probably for the 10 minutes that I'm supposed to be presenting, because this is real. The fact that the economy shrank in 2020 by 10%, which is the worst in 300 years. That's not the shock. The shock is that this was considered good news because it was nowhere near as bad as everybody thought, even though, and I'm sure there's some of you out there that like myself, that was around during the kind of devastation calls in the 2007-8 recession, which went on for a good 5 years. And as you can see, that was kind of like a blip in comparison. So an incredible kind of what has happened. And if we move on a couple of slides, I think there, Alan, to, yes, the economic forecast, just go back one. And basically what this shows is that the impact. So if we look at on here, there's lots of squiggly lines, I appreciate that. So this is basically what's the turnover of Britain, if you like, for want of a better word. And if you look at the green line coming off the black line at the start, that's the March 2020 forecast. So we were expected to be somewhere at, you know, just about 102.5% of where we have been in the past, where we had been back in 2020 at the start of the year. And at this moment, clearly, we're way below that. So we're not really expected to catch up to those levels. So the next one to have a little look at is the blue line below, which is the March 2021 forecast. So that is the forecast post the budget, basically, as far as I'm aware. So what you can see is that the economy is kind of a good 5% behind where it should be. And it's going to take a little time for it to catch up. So we are looking at another 3 or 4 years. Having said that, that is a remarkable rebound. And certainly everybody's talking at the moment, again, there were devastating forecasts for Q1 this year, but we don't seem to have had as bad a time as we kind of thought. The next slide looks at wages, and I think this one is, again, really kind of astounding at the moment, and good news, really good news for any landlords out there just now. And the reason for that is that we know that any rents that you charge are very, very much tied into wage growth and inflation. So anytime wage growth dips below inflation, you will struggle to raise your rents, and indeed you might see some falls. And I know kind of we've seen some falls in London, but we'll talk about that in a little bit. It doesn't help on this, by the way, that some of the lines are exactly the same colour in my head, or pretty much. But basically what we're looking at, and these are the kind of takeaways rather than trying to study which line is which, is that underlying wage growth is around 3% now, which is a fantastic result. And as you can see from the slide looking at November to January 2021, we're actually doing better as far as wage growth is concerned than we have for some time. Now, clearly that's a recovery from the big dip that we saw last year. But you're looking at average pay growth at about 4.8%. And when we're talking about unemployment, currently about to hit currently at 5% and expected to hit 6%, to have wage growth at this time is kind of astonishing. And it goes on to the fact that we really do have a very much a two-tier economy at the moment. Huge success, the property market of which is a good example, or indeed if you're a retailer, you're kind of flying high if you've been allowed to be open, to the food retailers, for example, versus those who've suffered in the catering and hospitality industry and just had a terrible time. And of course, people who were self-employed who haven't been able to get any funding have had perhaps the worst time, as well as those that have not sort of made it through the last 12 months. So the importance of that, I think, is really sort of looked at when we look at the different occupations, which is on the next slide, if I've remembered that correctly. So if we run through to the next one, there we go. So my advice really is, you can see what the average growth rate on wages is here. You can see that finance and business services, public sector, and various parts of the private sector operating well are doing superbly. And those are very much the safe tenants, if you like, for the future. So I've always thought we've never really looked at occupation enough as an industry. And this is definitely the time not to ignore it. You want to make sure that your tenants that you're taking on, particularly with the difficulty in evicting anybody at this moment in time, you need to make sure that they're a good, safe bet from that perspective. So that's kind of where we are economically. And basically, it's an awful lot better than we thought, but it's still pretty drastic. Having said that, the big surprise, of course, is that when you get an economic downturn, so either beforehand and will cause the economic downturn, or indeed after an economic downturn, you definitely will see the property market slide substantially, as it was predicted to do last year. And I'll talk about predictions in a little while. So if we move on now to see what's actually happened, of course, we've got this property boom, which nobody forecast. I was quite proud of myself about September last year, quite frankly, because I think I said, and I'm pretty sure it was somewhere on here, that I just couldn't quite see the falls that everybody was predicting. But I still expected sort of 0 to 5% falls. What I didn't expect was the numbers on the next slide, which basically blow away everything that we've seen ever before. I mean, this is a complete game changer. We've had a pandemic that is a 1 in 100 year event. And this is the first time ever that property prices have really rallied in the opposite direction to the economy. So one of the first ones here you'll see is the Northeast. So we can see that the data for the end of last year, the average house price there was £141,000. And interestingly, if you take that average price today, that's pretty much the same as it was 14 years ago. 14 years ago. So that's a decade and a half it's taken these guys to recover from the recession. But of course, you know, if you're a landlord and you're buying and you know sort of a good time to buy, if there is such a thing, you'd have seen a 10% growth in the last year. But it's taken that 10% hike for the Northeast just to get back to where it was. And these are nominal figures, so they're not including inflation. So anybody who's really owned a property in the Northeast with cash, which is not necessarily the best way to hold an investment, I'm afraid you're looking at quite a substantial fall in that in real terms. And that's really important to kind of bear in mind. You go down to the rest of them and you can see down in London, we've seen some decent house price growth, not as strong as the others. So you're looking at where I'm from the East Midlands. So you're looking at 10.6% growth. That had a great rebound. And the reason London hasn't had as big a rebound, it's not for bad reason, it's completely the opposite, is because that it's had this huge 66% growth over the last 14 years. So it's really important whenever you see a year-on-year figure, they're pushed all the time. Don't take that figure. You've got to understand it in context. So you could get very excited about investing in the Northeast, seeing 10% growth, but quite frankly, that's just bailed them out back to where they were in 2007. So, but an incredible result to see double-digit growth in the property market. So that's all very well. We kind of all know that. So where do we go next? So this is where it gets really exciting. Now, what I've done with this, what we found really interesting was to start looking at the forecasts in April 20, so this time last year, by the likes of Knight Frank, and I've got an all singing, all dancing statistical chart to show you, table to show you next, but I thought I'd start you easy off. So we looked at what were Knight Frank forecasting for the overall UK, London and prime central market back this time last year when we were in the middle of lockdown, and they were saying, you know, quite what seemed quite a fair forecast at the time, about a 3% fall UK, 2% in London, no change, interestingly, in the prime central market. Whereas in actual fact, instead of falls, we saw these pretty big growth rates. So those are the figures from the previous slide. What they were forecasting for this year, because they saw a 3% and 2%, 3% so fall last year, was big growth. So they were talking about 5%, 6% and 8% growth this time last year. But now, since the budget, what they're forecasting is not only have we got that 8.5% growth in the UK and 3.5% at the end of 2020 when it was expected to fall, but now what we're seeing is that, you know, rapid growth rate that they predicted this time last year for 21, if anybody's still following me on this, then in 2021, this year, again, they're looking at that growth rate holding, which is just unbelievable when we've seen the economic results that we have. So now that I've given you a little bit of an idea of what I'm up to on this slide, here's the big one. The next one is Savills. There you go. That is just like joy to me. I could eat this for breakfast every day. So this gets also really more fascinating because of what Savills were up to. So June last year, they were predicting by the end of 2020, there'd be 7.5% falls. And look what happened. Almost the opposite. Prices went in completely the opposite direction. This isn't because Savills are bad at what they're doing. Savills have an amazing team of 25 plus probably bright people, and they understand property. They really do. But this is so unprecedented in the way that we saw the property boom come through that it even took a company like this completely off guard, because the forecast that they did at 7.5% fall was quite conservative compared to other ones we've seen. So that kind of deals with last year. Now, June last year, they were predicting that based on those falls, just like those 7.5% falls, we'd see this strong rebound this year. But because then we had a strong rebound in increases in 2020, I'm onto the orange column for anybody that's lost me at this point, is that in 2021, because of the high growth in 2020, none of us really believed, and I certainly didn't believe, I thought Savills had nailed it in October, that there was any way that prices this year would rise higher than they were last year. You just couldn't see it, even you know, with quite sensible forecasters. So they were expecting no price growth this year. However, this is the influence that they expect the budget to have. And that is that the 5% guaranteed mortgages coming back, the 5% deposit, the unexpected tapering or extension of the stamp duty holiday and the tapering of it, which was a smart move by the government. And to be honest, we don't thank the government for much as landlords, but they really listened to the industry very hard. And we were very lucky to get those extensions and have that money boosted into the economy. So that is something we should be very grateful for. And what they're now seeing is equally strong growth for 2021 post the March budget. And then the other three columns are the forecasts for June. They did June last year, October last year, March this year for the overall increase over the next 5 years. So currently the overall increase in the UK is 21%. They forecast last year 20% and in June about 15%. So one of the reasons I'm showing you this is firstly because this just shows you how difficult it is for people that are spending every single day with huge capacity, huge knowledge to get an annual forecast right. But what is interesting is when you look at their 5-year forecasts, they actually haven't changed that much. It's the annual forecast that's very, very difficult to correct. So when you hear this stuff about, is this the best year to invest? It's all rubbish, really, because nobody should be investing unless you're flipping or investing, building and selling. Certainly as a buy-to-let landlord, you're in this for the next 15 to 20 years. And the only real forecast figures I think that you can hold any stall, certainly in my experience, is the 5-year forecasts, because they're the ones that don't change. Year in and year out, it's really, really difficult to get that right. So what does that look like next? So we've seen all of the forecasts. And what I've done on the next slide is kind of mix the two, because I think this shows a bit of a fascinating story. And what this shows you is between, so if we take the first one, we're looking at London. Basically what that says is between 2000 and 2005, the actual growth in house prices on average was 78% over a 5-year period. I'll come back and explain some of these figures. Then it was much lower the next year, 20%. Bit higher the next, and that was because of the recession, higher the next year because we saw the rebound start in London in 2013. So you got a good couple of years price growth in there, and then around 18% over the last 5 years. And then the forecast, just to put those in context, for London are pretty much the next 5 years will be as good as, or however you consider it, as the last 5 years. So you start looking in that first column of 2000, 2005, what you see in, and this is what I've done, certainly from a property investment perspective, I ignore any price growth that I see on a property on an individual street, or indeed on an average basis, to show you how wonderful property is an investment from anything before 2005. And the reason is that in those 5 years, pretty much every property doubled in value, if not more, because of huge funds coming in. And I know I've spoken at that in the past. And what it also shows you, I'm trying to kind of convey, if you like, how house prices work. And it is like a wave. So you had this amazing kind of tsunami of house price growth in 2000, 2005. Interestingly, not so strong in London. But what you then see is London comes back a little later. So all the different areas, and this applies to probably individual properties as well, all the different areas have different wave heights. But as soon as they hit a big wave, the likelihood is the next wave won't be quite so big. And it's just a useful kind of thing to understand in the back of your mind, and also know that house prices over the next 5 years, even if this is your only takeaway, probably going to be reasonably similar, maybe slightly better than the last 5 years, depending on how they've performed. So I hope that's kind of helpful, just to give you a bit of a better understanding of what's expected and how realistic that is. So of course, that's only half the story. Rents are the next one. And again, astonishingly, rents have pretty much risen over the last 12 months. London's had a bit of a tough time, but more because of the huge increase in supply from short-term accommodation that's come into the market. So on this one, what you can see is that, again, they've got two colors. I'm going to write to them and ask them to do different colors because it's quite hard to read it. But the top one that you see on the left-hand side, so January 2012, where you see a 3% rise, I'm pretty confident that's the same color as England. As you can see, it goes up and down, up and down. And we're now pretty much at that sort of 1.5% on average. Northern Ireland's slightly different. They've got a little bit of a higher rise there. And you can see that Wales and Scotland has its ups and downs as well. But the interesting thing is, despite the accusation of the market of skyrocketing rents, extortionate rents, you're looking at nothing really going beyond 2% since 2017, apart from Northern Ireland. So we do know that rents are actually one of the perfect economic markets that you can get. They're tied into wages. The government couldn't ask for a better market to operate, to be honest. And as a result of that, it's why I always say it would actually be in landlords' favour to move rents in line with inflation, because typically inflation up until now has actually been rising faster than people's wages. So never be too frightened about rent controls, because weirdly, I fundamentally believe that would help you, not harm you in any way, shape, or form. If you pop onto the next slide, it makes a little bit more sense because we move to a nice easy bar chart, and there you see the average in England's just over 1.5%, and that's good news to some extent. That's just above inflation, because inflation is incredibly low at this moment. And probably really the Southwest and the East Midlands are the two areas that are doing well at beating inflation. And East Midlands, I have to say, part of that is, again, looking at how we looked at the history of property prices. That's because rents have been held back quite a lot in the East Midlands. And that's kind of my patch. So I've got a lot of data on that. And I think in the Southwest, it's just there's a lot of people going there with a lot of money that can help push, but not big rises, nowhere rising more than sort of over 2%. So, but it's good because it's still going in the upwards direction. So in terms of moving forward and where the rental forecasts are going to be, Savills are really the only guys that have come up with that. And on the next slide, you can see that it's pretty rosy picture, to be honest. So you're looking at pretty similar growth in rents over the next 5 years to house prices. And that in itself is very unusual. House prices normally smash the growth rate of rents, for the reason that I mentioned about rents moving more in line with wages than they do in the pricing market. You've got equity to play with, and that kind of average income, average house price, that methodology and that measure has really been broken since 2000, 2005, when we looked at the market before. So we're looking at some pretty good growth over the next 4 or 5 years, whether you're in the sort of prime market or you're looking at a sort of average rental growth. And certainly outside of London, they're looking at some pretty good growth at this moment in time. London suffered, but the good news is it's likely to come back. So an incredibly rosy picture, considering we're in the worst economic state we've ever been in. It's almost like, you know, I'd be here as a grim reaper normally, whereas I get to present this kind of lovely news to you. So it's not all rosy if we pop into the kind of what to watch out for, because of course the government is still obsessed with driving home ownership, and still, in my view, got this completely bonkers attitude that if you drive home ownership, somehow you will sort the housing crisis out. Whereas actually the real area of problems is in the social homes. There aren't enough social homes. And there's 1 million people renting in the private rented sector because the government didn't build enough social homes. So not the landlord's fault by any stretch of the imagination, which does continue to wind me up, but they are just not listening. And I have tried, and others have tried, but it is still like banging our head against a brick wall. Interestingly, I do a lot of work on the home buying and selling side. Habito have been very, very supportive and really good on this too, in trying to change the way we buy and sell a house. So the good news is, although I've got some sort of things to watch out for here, buying and selling a home, I'm pretty much there that we can promise you that process is going to get much better. And that's partly, and I would say this thanks to people like Habito, who are really, really starting to change the way that the market works, and bringing in new things that in a market, particularly in mortgages, that has, to be honest, been exactly the same for the last sort of 30 years, give or take a few tweaks. So we have got some really exciting businesses coming forward. really putting the consumer first, and that is going to really help you to buy and sell more easily. On the other hand, I've put down March, so obviously it's 1st of April for the new electrics. We tried to get that extended, but nobody was listening. The evictions currently, I think it's end of May now, but I daren't almost put that on a slide, because as soon as I mention it, the government put it back again. And I wouldn't bank on them not putting it back once more. What they've done in the English government is they've created a complete catch-22, because tenants who are in this situation haven't been paying rent for 6 months to a year. They're going to be forced out and forced to evict, rather than the government giving them loans, which is what Scotland and Wales very, very sensibly did. So again, government is trying to kind of beat up the landlord, but the people who are suffering at the end of the day is the tenant. And until we can get the government to understand that, it's going to be really kind of quite harsh. EPC rating, there's a consultation out at the moment. Should it be C by 2028? My honest answer is, do you know what? Just get on with it. We've all got to improve EPC ratings. If you're renovating a property, get it up to C if you can, and if you can get up to B and A, do it. The lower those utility bills, the more likely the tenant is to pay your rent. It's just a no-brainer from my perspective. So really make sure that you're, at every possibility, you're renovating a property and you're improving its EPC as you go. We mentioned the kind of supporting home ownership versus renting, and I think the anti kind of landlord policies, for want of a better phrase, are going to continue. However, probably the biggest news, and I could kind of hear sighs of relief from people, not only those who are worried about the stamp duty holiday not being extended, was on the tax front. I am amazed that they didn't go for CGT. I think there's something coming up. I don't know if Habito guys can talk a little bit more about this in the next couple of weeks, because I know CGT is being looked at. But I kind of still be surprised. So again, if you haven't taken tax advice now, for crying out loud, please, please, please go and get expert tax advice to try and hang on to what money you can when the government come to raid it, because I still think that's a serious possibility. So where is kind of other landlords at if we kind of move on? I think it's been really interesting over the last 6 months. So many people are still committed to property investment. Why wouldn't you be? When everywhere else is dying on its feet, property has absolutely just gone, hey, people have just gone roof over my head, whether I'm renting or buying. It's the most important thing, and I'm going to spend what money I can to get to live somewhere I love. There have been some suggestions of landlords selling up. And that has happened, there's no doubt. And a lot of them are actually taking advantage of the rise in property prices that we've seen. But again, when you look at the actual figures, Home Track, very respected at their figures, that's less than 1% of the PRS stock. So I wouldn't listen to their headlines too much on that. The pandemic has definitely increased the value of stock in people's minds and what a property is worth. And, you know, at the end of the day, though, from a buy-to-let perspective, this is very, very much a long-term investment, and you've got to see it at that. And you've got to understand those individual and regional differences. And hopefully the data that I put up earlier is useful to you. And I've spoken to so many people over the last 3 or 4 years who are going, when's the market going to crash? And you see on the forums, well, it'll crash. It's got to crash, blah, blah, blah. Well, everybody's been waiting for that since Brexit, way before Brexit, 3 or 4 years ago. And yes, it will at some point. But no one's forecasting that in the short term. No one can see it happening. And you've got to kind of wonder if the amazing people at Savills can't forecast that, then how on earth can the rest of us, mere mortals, certainly from my perspective, do it? So my kind of summary is, on the next slide, is that, do you know what? It will probably be a little bit bumpy in some way, shape, form over the next couple of years, certainly from an eviction perspective and other changes of government. But if you focus on your local property data, if you're realistic about what property deliver, take tax advice, look to the long term. I'm really struggling to see, even on a, even on a cautious note, really, how the future can't be bright from a property perspective. So I promised you that I'd go over time, and I have, and I'm really sorry. I hope that was useful. And Dale said he can do his in 2 minutes.
No, thank you so much, Kate. Apology, obviously, for Dale and Martijn. We did say that Kate would overrun, but I hope you don't mind that we allowed Kate to overrun, because I think there was some great stuff there, some real important insights. And I'm sure that has triggered some questions that you want to put to Kate. So just as a reminder from me, please use the Q&A facility to post your questions, either to me directly or so that everyone can see, and we'll hopefully cover those later in the panel session. So thank you once again, Kate. Let's move, oh, apologies. Dale, over to you, sir.
My 2 minutes starts now. Right, okay. Thank you.
I'll give you slightly longer, don't worry.
That's fine. Hi, everybody. Thank you for having me. Some amazing stats there from Kate. And without a doubt, we could never have seen or would never believe where we were 12 months ago. And we were going into the pandemic. It was literally my birthday, 23rd of March, and all of the lenders, or the majority of the lenders that we were dealing with, literally shut their doors. The valuers couldn't go out to the properties and so on. So actually 12 months on, to be in this such a positive entity, and Kate's figures there showing some real positives. I just wanted to show today, lenders are lending. We've got a lot of opportunities, and Alan, if we can go to the next slide, please. We're very much in the specialist area, so covering various parts of the entity, the market. Obviously, we deal with Habito and have done for the last 15 months. We've got a really great relationship, and we work together very closely to assist as many customers as possible. We look at very complex entities, so they could be cross charges on a number of properties, they could be joint borrower, sole proprietor, etc. So, and even the over 55s, there's no age limit in our world now. So some lenders have no maximum age at all. So going up to 100 at the end of the mortgage term is something that's pretty feasible in the current climates. Bridging commercial, we'll come on to that in a second. Very much short-term finance, non-residential, etc. And then we've got second charges as well that we deal with. So even if a first charge doesn't, or if you've got a good first charge already and you need to raise some extra funds, we can look at doing seconds. But the really big thing, obviously, we're talking about today is buy-to-lets. And we've got, we're very lucky in that the volume of business we do and the relationship we have with a lot of our lenders, they actually put underwriters into our office. And therefore, we can slightly do things that might not be the ordinary, or especially where the high street says no. Those are the sort of things that we really specialize in and try to get things done for you. I sit on the Association of Mortgage Intermediaries Industry Contact Group, which is great because I see things before they happen, and occasionally on the FCA Packager and Master Broker Forum as well. Next slide, please, Alan. So just very quickly, just to go through some of the things that are very much in the market currently. First-time buyer, first-time landlords, very much so. We can go right up to 80% in the buy-to-let sector as a whole. I think the biggest thing at the moment is credit scoring. When the computer says no on the high street, what do you do next? A lot of our lenders now will actually manually assess. So if your credit score is not quite high enough to go through the high streets, then those are the sort of things that we've got a lot of lenders now that are quite happy to ignore technology and go back to basics and manually assess. If there is a reason to do the deal, then we've probably got a lender that will look at it. Like I said earlier, there's no maximum age, but also there's no minimum income and no minimum trading period. So we can do, people who have come fresh into the marketplace, got a new job just recently, they don't have to be trading for a certain amount of time, and gone are the days where there had to be a minimum income of £30,000 as well. So those sort of things are long gone. I would say the biggest entity we're seeing at the moment, the biggest increase are HMOs and student lets, and probably on a refurb basis as well, where you may well buy a 3-bedroom entity, a 3-bedroom buy-to-let, and actually convert it into a 5-bedroom HMO. We are in the age of millennials. They are quite happy to rent a room. And we've got lenders that will not stress test a back book as well. So if you've got portfolio in the back book and it's a little bit close to the borderline, then some lenders will not look at that either. Refurb obviously is one of the biggest things without a doubt. And if you're paying for properties with cash, we can now do day one remortgages as well for some lenders. But I would also say at the moment, I think, and I'll come on to a prime case example in a second, where we are seeing people now who have had a credit blip, maybe not their fault, but a credit blip in the past, so maybe a default or a CCJ or a missed payment on a utility bill. And I think we're going to see a lot more of those over the next few months as we come out of furlough schemes and so on. So actually almost the near prime almost is daily for us at the moment in seeing these sort of things. And then Kate mentioned energy certificates. I agree with the part C, but actually we're seeing a lot of lenders now who are looking at green deals. And we're actually seeing lenders now looking at increasing the energy certificates as well. But their requests are obviously at E at the moment, but I think I agree 2028 probably we'll see a minimum of C. Can we go on to the next one, please? So these are the questions we're getting asked quite a lot over the last couple of weeks. You can see, you know, it's a definitely a buoyant entity, the buy-to-let sector, but it can be confusing as well. So just, you know, touching on a couple of these, there's a lot of rental calculations with regards to how much can I borrow, what is the maximum loan a lender will give to me, and these can be 125% of the pay rate, 145%, depends on whether you're a high rate taxpayer, a lower rate taxpayer. It can be on the pay rate, or it can be 2% over the pay rate plus reversion rate, whether personal or in a limited company name, and so on and so on. These are sort of things that we come to the forefront with. We'll help you, we'll take that pain, we'll come back to you and say, these are the maximum deals, depending on the maximum loan size that you can raise, depending on the lender that we go with, and whether you do it on a 5-year fixed rate or whether you do it in a personal or limited company name. Talking to advisors is a key thing in the current climate. So I think really advice now is crucial, and predicting for the next sort of 2 to 5 years where you're going to be, what you're going to be doing, and the areas as well. Is there going to be a north-south divide? Absolutely. At the moment, we're seeing a lot of people from the south buying up in the north. The yields are obviously a lot better up there at the moment, and with house prices still increasing down in the south here, and we're seeing house prices, we're in the Gatwick area, houses are going up for sale, being sold even before they hit the websites for 10, 20,000 over the asking price. So absolutely, yields are chasing yields is a big thing at the moment. And like I said earlier, HMO is massive. We've got lenders that will look at 6 bedrooms, we've got lenders that will look at 8 bedrooms. I think we've done a 22 bedroom in the last 6 months. So again, depending on the right deal, depending on the right property, give us a shout and we'll see what we can do. But lenders most definitely are active, without a doubt. They want to lend. And we've seen that over the last couple of days with lenders coming out with 95% in the first time buyer market. But actually first time buyers are still struggling to get on the ladder. Therefore, the buy-to-let sector is still going to be strong for a long time yet. And then finally, valuers, are they got delays? Yes, valuers have delays at the moment. Sorry, back one slide, sorry. Valuers are still in the marketplace at the moment. It all depends on the lender that you're dealing with, and will depend on when they what point they instruct the valuation. It could be the valuer is instructed right at the outset, or it could be they won't instruct the valuation until the lender has actually seen the whole case. So just be wary of those delays if you're in a rush or in a race to get an offer out. Sorry, Alan, next slide, thank you. So then we move on to bridging and commercial. Very much the 3 main points on this one at the moment are refurbishments. Some lenders now allow you to refurb a property on a short-term entity with them and then refinance onto a term product with them also. And the benefits of this, obviously, you're using the same underwriter, you're using the same valuer in some cases. And more importantly, they get to know the project you're working on and can actually have a chat with you about it. They want to see everything up front, but in the main, sometimes now you can do the same refurb and then onto a term product with the same lender. I'd say the biggest one currently we have is chain break finance, where right at the last minute someone pulls out the chain, making the whole thing either collapse or get delayed, and therefore we're looking at short-term loans to cover that break. And right at the bottom, you've got the stamp duty land tax deadline, obviously in June. It was in March. There were quite a few people who were panicking and looking at bridging finance. It's not necessarily the right products to beat the stamp duty deadline. It all depends on individual circumstances, but it can be a costly exercise. So it's down to talking to a professional to make sure it fits for you. So just going on to a couple of case studies. This one here, seek out the professionals, because this one here was with a broker, and actually they just thought that even though the client declined first of all to get a buy-to-let, they were hoping that time would eradicate that issue and their credit score would increase and so on. But actually the bottom line was there was a linked address in the background where there was a buy-to-let with a bit of adverse, and it was really simple just to have a look, get a search on the linked address and find what the issue was and then resolve it. And more importantly, we transferred the client from a consent to let into a full buy-to-let and ensured they had no issues in the future moving forward, and then we saved them £100 a month as well. Next one, please. This one was a developer who had built 9 flats in a property, but they actually couldn't sell them because of the timing. This was right before the Brexit scenario, and the projects were set up in a company name. So they actually ran at a loss. All the expenses were put through, the company ran at a loss, and once the properties were sold, then they would take all the money out and shut the company down. But one of the shareholders was also abroad. So actually the company running at a loss and the shareholder abroad made it difficult for the development loan to be repaid. But we managed to refinance that to a term buy-to-let mortgage lender, which gave the developer a little bit more breathing space and meant they could rent it out their property in the meantime. Next one, please. This one was a little bit more difficult because it was actually a property where the bridge was on the residential farmhouse, and they needed, it was on a roll-up interest, so the bridging loan was rolling up the interest, and the time had actually run out to repay it, and the lender who had the debt was no longer lending, so they demanded the money back, and therefore there was a monthly payment due of about £15,000 or £16,000 per month, which obviously is a lot of money to pay on an entity. But actually we managed to find that they had a little bit more land in the background, which we could cross-collateral charge on, and gave that to the lender as added security, even though the lender had said no directly to the client. Last one, please. And then finally, this one was a barn conversion, which where the structure was strong, it was deemed as heavy refurbishment effectively. So although they did need planning permission, we managed to get 75% LTV overall. And again, there was an additional property in the background, which was a residential, which we could add another charge to. So quite a few bits. Basically, if there was a reason to do the deal, we've got some decent security and decent income in the background, we're probably going to have a lender to do that. Next slide, please. Next one. So, just very quickly, we are interviewing people all the time. So as you can see there, we've got interviewing Landbay, I think, on the left-hand side. If you wanted to log on at any point and find us on the websites, that's fine. Go on to the next one, Alan. We're done. Go onto the website, find us on that basis, and here's a couple of my team. But the big thing really is that we've been around 30 years and we're here for the long term. And we've got a great relationship with people at Habito and some other lenders on our panel as well to help you get the right mortgage for your needs and requirements. So give us a call.
Great.
Thank you very much.
No, thank you, Dale. That was excellent. I think definitely illustrates the value of the broker support and getting the right advice and tailoring it to the specific circumstances. So thank you very much. I see already that the questions are starting to come in, and I'm sure obviously there may be some things that Dale has mentioned there that maybe has prompted some more questions. So please keep your questions coming in on the Q&A so we can collate those and cover those in a moment. But last but not least, over to you, Martijn. Can you talk to us a bit more about the market?
Sure, I can. Good evening, everyone, and congratulations, Dale, for your birthday last week. Much nicer than last year, less clear. So thank you, both panelists, for the insight. Fascinating. I'll talk a little bit about what we see at Habito. We're both a broker and a lender, so we see a couple of things going on in the market and trying to bring some different insights than what you heard. And specifically, Kate is correct. You should never time the market. You should make a buy-to-let investment or indeed any property investment because you have the time for that type of investment. Because house price will fluctuate, economics will fluctuate. You just want to build. You want to make sure it's the right property for your purpose, and you have the liquidity to stick with it for a while. So there are good reasons for that. Alan, next slide, please. So why is the investment dictum, thou shalt not time any market? Well, particularly for buy-to-let. If you find yourself thinking, well, I won't go just now because there may be better rent if I wait a bit. Just be aware of the opportunity costs. So a month of void means that you have to get your money back in a year. You need to get 8% more rent from that next person you're waiting for. If it's 2 months, it's 16. So you got to be sure that you're getting better rent too, because the void period is no income. You may wait to buy because you think mortgage rate will go up, because maybe European Union particularly is raising rates. Bank of England sometimes talks about negative interest rates. That is possible, but house price volatility, and in the last 20 years, as Kate showed, growth tends to be higher than the difference between mortgage rates from week to week. There are definitely trends, and they've been downward for the last 5 years or so. But I wouldn't spend a particular month thinking is the next price rise going to be down or up. And then the tax regime may change. It does all the time. So again, be very careful, particularly now. Well, could I still afford my business if there was CGT at the end? But having taken that into account, and not investing at all or investing it in a savings account is not a high yield either. So think about what does it do? So you shouldn't time a market. You should know what you're doing in investment. If you are planning some things anyway, this may be quite a benign period in buy-to-lets. Next slide. And there are three reasons why maybe the next few months are special, and I'll go into those. So all the structures still there, symbolized by the untitled bubbles. But there are three things going on that are interesting. One is about stamp duty, where there have been a lot of announcement on budget day. One is around mortgage pricing, and one is about the house price and rent for the underlying assets of buy-to-let. So let me get into those in turn. First, buy-to-let. Can I have the next slide? So as the Chancellor stood up and spoke, 2 months ago, he announced a couple of things. One of them was a 95% LTV guarantee scheme for the residential market. Nothing to do with buy-to-let, but does give confidence to house prices. I think it's one of the reasons why there's a much rosier picture in house prices than there was. And the second is that the stamp duty that had only 3 weeks left in its exemption when he started speaking. So that's a bit short. So actually, he announced 2 extension or a tapering of extension, and the resulting rates are on the page here. So it's a bit complicated, but basically there is an exemption. You don't have to pay stamp duty up to 500k now if you're a residential investor. If you are a buy-to-let investor, you have to pay 2% more, whether you're a company or individual. And you can see the rate going now from 3 to all the way to 15% or high. Buy-to-let tends to, vast majority tends to be in the bottom 3 bracket here. As of the September 30th, so completed before the September 30th, incidentally my birthday, that is the last day you can get 3%. Sorry, that you can get the rates that follow there. So the difference between the June and September deadlines is that up to 250k, nothing changes. But from 250,000 to 500,000 pound property value, you pay 8% on that portrait. So you still pay under 3% on the first 250. And then after October 1st, it's business as usual as it was, which means that the 125 to 250,000 band also starts attracting a higher rate at this, and that's 5%. So with that, there's been quite a lot of activity. Rightmove announced the day after the budget was its busiest day ever for new inquiries. We've been very busy at Habito with inbound traffic, and there's been a lot of confidence. The challenge now is the conveyancers and the councils that they need to get a check form being ready on time, because they're working hard, but it's remote. There was a lot of capacity. There's still some people on furlough, particularly in the councils. So when you buy, try to get everything and all the paperwork as soon as you can, so you can hit the, probably June is going to be tight, but certainly the September deadline. And make sure that in your investment case, you could cope if you miss it by a bit. But anything you can do, getting a good broker, getting a solicitor that has some capacity, making sure all your paperwork is there as soon as, all helps to hit the deadline. Okay, so that's stamp duty. The second is, as that stamp duty is there, there's one more thing that people are considering, and we're seeing more and more of that, and I talked about this earlier in this forum, is that as a result of the tax changes that were announced 5 years ago, it is less attractive to hold a buy-to-let mortgage as an individual, and more attractive as a company than it was before. There are quite a lot of considerations you have to take into account. But in short, as you before, you could deduct all your mortgage payment as a expense at your marginal tax rate. Now, after 5 years of tapering, you can only deduct that at 20% tax, which means there's less of a tax benefit. So it's more expensive, less profitable. A company attracts 90% corporation tax rather than 40% income tax. Why, if you get a personal tax advice, as a rule, it's got more attractive than it was 5 years ago. Now, as there's one of the reasons that it's hard if you didn't set it up as a company in the first place is the cost on the right. You need to set up a company, which is still the case, and that can be between 150 but it can be as high as £600. There's still getting a mortgage, mortgage fees, and there's ongoing admin, or if you have to make you have to go to the company's house, put your accounts and all of those things. But the SDLT, the stamp duty of converting, you have to pay stamp duty as it's a sale from an individual to a company. If it's below the threshold we just talked about, is now exempt. And of course, mortgage broker, there are now very good free mortgage brokers available, like Habito, that is free to the consumer. So if you were planning to do it anyway, now is a good time, would be my advice. Then onto the asset prices. So Kate talked about house prices, so I won't do that again. But I think fair to say that we're feeling, well, last March we were all panicking and we were talking about it's definitely going down, but we're not sure about how much. We are now not too sure, and it doesn't turn out to be the disaster we feared. Rents has gone through an interesting period. If you zoom in a bit on the rent chart that Kate showed. So this is Rightmove data, and rents have fallen typically in the country. There's a couple of cities, particularly as people sort of got a bit more into town living and out of city living, and there's been a rent change downwards in many of the cities. Not dramatic, but quite noticeable. In the last few months or so, particularly in London, rents have started to go up again. And what is remarkable is that the rental inquiries, particularly in the last few months, have gone up enormously. So it looks like supply and demand is still there. Rents go down, more people want to rent in the cities. So we could be seeing support for city rent in the next few months, which is interesting. But most is individual property, but as a macro backdrop, you're seeing that it doesn't look like the story that everyone's moving out of cities and living in the countryside is actually true. And there are people ready to commit again. And then the last thing I wanted to touch on is mortgage pricing. As I said, it had been fallen across the board, peaks and troughs for the last 5 years or so. As there was a long peak and lower underlying swap rates, the rates that banks finance themselves with. We are seeing historically low pricing. I'm not saying it can't go a bit lower, maybe it will, and it is definitely lower at 2-year fixed, and it is lower at low LTVs than it's been where some of the higher end mortgages have gone up. What we are seeing now, though, is rates at sort of just below 4%, between 3.4 and 3.9 in this example, is quite low for 5-year fixed. Particularly longer term are getting a bit smaller. And if you look at those swap rates, you see the longer end, like 10 years and even longer swaps, have gone up in the last 6 weeks, which typically is indicating that the shorter end, like 5 and 3-year fixes, are going to be pricier in the next 2 months as they roll forward. So it suggests it is more likely that it's going to increase than decrease at the sort of mid-level of 3 and 5-year fixed. I put an example here, not just because Habito has the best product, but I think just as for the entire industry, try to get a broker because this is quite complicated to look at what's the best mortgage for me. It depends on your circumstances, but also look at this example. The initial rate is not the best product in terms of what will you pay for 5 years, as the fees are different. And in our case, there's a large cashback payable right now that helps. So this only makes sense if you have a conversation with someone about, well, what do I value? Money up front, the first payment being low, how long do you want to fix over, what's the total value? If you want to make your own spreadsheet, please do, but make sure it has lots of columns, because there's a lot to consider, and get some advice when you can. So we can talk about a lot of things, but these three things: rents look like they're bouncing back up. Stamp duty is giving a longer period of confidence and transaction boom than we assumed 6 weeks ago. And mortgage pricing is looking quite attractive by historic standards. Means that there are a couple of reasons why people should look to have a higher interest in buy-to-let. That is exactly what we're seeing. Go to the last slide, Alan. Just these are our figures, and this is comparing what we see in this quarter that is ending tomorrow, and versus what we saw the quarter before. And it gives a bit of, if you go from top to bottom, it gives a bit of a sign of the elephant going through the snake, so to speak. So we've seen an enormous increase in completions of way more than double last quarter, and that is good sign for us. But more importantly, that is the post-lockdown activity when the market reopens finally completing, as we go through the longer cycle of getting from submission to offer, and particularly from offer to completion. So that's going through. So there's not as much breakage as we feared at some point. So there is, the chains are holding across the piece relatively well. It just takes a long time. And then in the last few months, brokerage inquiries, people starting the journey is double what it was a quarter ago. So we're seeing more activity. And from what we can tell, and Dale will be able to comment as well, we're seeing people, if anything, more transaction ready than before. So there's not just people having a go. People are pretty purchase intent. And there's a bit of, when we talk to customers, a bit of people that have delayed maybe their plans last March and said, well, looks like the world is ending, I'm going to sit this one out for a bit, are coming back in and doing what they planned to do a year ago. And then that's feeding through to lending applications, which is up a third on the last quarter. And that is, given the normal seasonality, is strong. It does show that there is also a little bit of a delay from people inquiring to really applying. There are maybe also a little bit more time for lender queries, as some lenders are struggling with demand at the moment. So overall, I see a lot of supply reasons why there should be a healthy market, but it looks like customers have caught onto that and have started to move about a quarter ago.
Great, thank you, Martijn. That was excellent. So it definitely told me that I need to pay attention to when people's birthdays are, because it seems that major events happen on those key dates. So definitely one to watch. Right, we have got lots of questions that have flooded in. So thank you to all of our panelists, but now is the time to put you on the spot. I'll try to be fair and distribute the questions accordingly. I'm going to start with one that came in actually before we started, from Frederick, who actually regularly submits some questions to us. And actually was something you touched upon there, Martijn, about rates, buy-to-let rates. I think Frederick was kind of suggesting, we're going to see a narrowing of the gap between buy-to-let limited company rates and residential rates. From what you said there, perhaps not so, but interested to get your take, and Dale and Kate's on that.
Yeah, maybe if I may start. There's sort of been two bits of the buy-to-let markets for a while: high street versus specialist. And so all company buy-to-lets in specialists, that higher LTV and sort of the circumstances Dale talked about, which makes specialists versus high street about 2/3 high street, 1/3 specialists, I would say. And the high street sector is dominated by a handful of banks, and they do lots of volume, simple cases, and great products if you're right. There's been a more of a difference between those two sectors in pricing than there has been in the past. That has been going on for a year, and if I look at that split, at the 2-year end, there's a bigger gap, and the longer you go into tenor, the smaller that gap is. My take on this is, as there's also been some credit policy tightening, that is sort of a conservative view on the macro environment in those big banks, and so well, let's put our volume in the safer, lower capital intensive mortgages. So I think a 60% LTV 2-year fixed is probably going to be cheaper from high street, and that's become more cheaper as the appetite to do lots of 80% LTV company has disappeared. So I think the flip side of that same coin is that the specialist sector probably gets a bit bigger as some lenders are seeing interesting yield opportunities. And there's a complicated set of capital and liquidity rules, which means that banks need to behave a bit different to other specialist lenders.
Okay, thank you. Dale, what do you think in terms of rates and what we can foresee?
I think it's difficult to predict anything at the moment. We're seeing unprecedented times across the board. I think 8 out of 10 of every buy-to-lets we're doing at the moment are in limited company names, and that's down to the individual and the individual tax advisors and so on and so on. But like Martijn said today, the lenders at the moment are looking to A, catch up on business maybe they didn't do last year, but also B, there is margin to be made right now. So we are seeing maybe the rates are lower, but the arrangement fees are slightly higher. And it's just one of those markets at the moment where you just need to look at the bottom line, look at the small print, compare it. You don't always jump for the lowest rate because it doesn't necessarily mean it's going to be the best option for you. And then have a look at what the arrangement fees are going to be, and if there are any exit fees later on. Lenders do charge admin fees as well, and they can range from anything from £50 right up to £299, and that can make quite a big difference when you're doing your budgets and your calculations. So, but actually the rate difference between a limited company now and a personal entity, they're very, very small margins compared to where they used to be 3-5 years ago, when they used to be 1%, 1.5% difference in the rate itself than anything else.
Okay. And Kate, anything to add on that? Or?
I'm going to leave the mortgage guys some extra time because I think so much. I'm just going to zip it on mortgages.
Okay. I'm going to come back to you in a moment, Kate, because there is a meaty question that I want to get into. But Dale, there was one from Charlie around bridging loans. And he was saying that it took a long time to get the paperwork, almost lost the opportunity. Is there such a thing as like an agreement on the person, the track record to make the process any quicker for when he gets the next opportunity?
That's a great question. I think like most, I think the bridging lenders were also unaware of the volumes that were going to come their way. And once people made, lenders have made people redundant or furloughed and so on, all of a sudden this wave of new business came everybody's way, and people started getting a little bit delayed. Now, I think at the end of the last quarter, I think the average bridging loan was taking about 56 days to go from start to finish, when you actually think bridging loans should be really, really quick. Some lenders, to be fair, can turn bridging loans round from application to finance within just a few days, but in the main, the average is about 56 days, mainly because I think there's a lot of solicitors. People like to use their own solicitors, a family solicitor that's been in the family mindset for the last 30 years, etc., etc. They know everything, but actually when it comes to bridging loans, they don't. They've got no idea at all. And it's always good to do a bit of homework to make sure that that solicitor knows the lender, knows the bridging understanding, and actually maybe can act for you and the lender at the same time to make the process a lot quicker, rather than dealing with the family solicitor who thinks they know it all, but unfortunately they don't, and therefore some delays happen just purely out of circumstances rather than a want to complete as quickly as possible. But just be wary in the current climate. Just check the timescales with doing bridging loans, because it can take a while. With regards to actually doing it on an individual, unfortunately not at the moment. It'd be great if we could pre-qualify individuals to do stuff across the market. That'd be brilliant. And there was a time, probably about 10-12 years ago, we managed to do it on the mortgage side, but unfortunately not at the moment. I'm hoping it will come back at some point, but not currently.
Okay, thank you. Does anyone else want to cover that, or are you happy with? No? Okay, I'll move on. That's fine. So Kate, there's a question from Valerie, which you may have read, but
I have.
I can paraphrase, but obviously you were talking about maybe the Welsh English position being slightly different in terms of tenant loans, obviously arrears, evictions being halted, how we all come out of this. I think the particular question is around referencing and moving to a new rental. Would you like to cover that?
Yeah, definitely, definitely. And I have to say, Valerie's knows the rental market like the back of her hand. She's a bit of she's very good at this. So what I think is that she's highlighted is absolutely right, is that, you know, the government, I just still cannot understand the government's sort of attitude, really, that if we hurt landlords, tenants will be fine, because they won't, and they are going to suffer. There was a 165% increase in homelessness between 2010 and I think it was this time last year. And most of that, I believe, has been because, partly because landlords have left the market, but also because the universal credit is so badly paid. And to accuse landlords of being biased against people on benefits, when in actual fact, what they're saying to the government is, look, the system's rubbish compared to the private sector, somebody paying privately. And therefore, you know, they've almost forced people out of their homes by a lack of support through universal credit. And I just don't know how much more of an increase you need in homelessness for the government to start realizing we have a basic population increase. We need more homes to own. We need more homes to rent, and we absolutely need, if the government want to solve this housing issue, more social homes. And until the government kind of get their heads around that and work out that increasing home ownership is not going to solve the issues that are in the rental market, we're going to be in this awful situation that they're forcing tenants into through COVID, kind of making the landlord pay initially, but the big payers are going to be all of those tenants that now, that in the future, will not be able to find accommodation. So one of the things I will be doing, I don't mind saying, is writing to them and say, can you please explain how a tenant who's been forced into arrears because you wouldn't offer the tenant loans that we asked for, how on earth are they going to, where are you going to put them in the future? What is your plan to house these as well as all the homeless? Because this is your problem, you caused it, you know, we gave you a solution, you decided not to take it, what are you going to do about it? And that's really because I don't know any other way of trying to get the government to listen, but to say, well, look, we warned you about this. We warned them about the pet problems that would exist if we capped the deposits, and then they come back and go, oh, there's a pet problem, and it's like, yeah, it's funny that, hey, those 5 emails I sent you on it that you didn't listen to and told me it wouldn't be a problem. So it is, Valerie's absolutely right. It's just heartbreaking, to be honest, to treat tenants in this way, whereas they think they're kind of doing the clever thing, and it's just not. It's just not. So it's going to be a difficult time, but I think the landlords will come out of it, but I don't think the tenants will come out of it well at all. Okay,
thank you. I suppose just moving on, just touching upon some of the other questions we've had about typical rental yields, what demand looks like in a longer forecast, 5 to 10 years, if you are able to kind of put your crystal ball to that. I'm just interested to get your views across the panel, really, as to what you think the immediate challenges and opportunities are, and how that demand will change. Who wants? Dale, do you want to go first?
Yeah, difficult question for the next 5 years. Without a doubt, I can't think about what I'm doing tomorrow, Leno, 5 years time. I think across the board at the moment, I think we're just, you know, like Kate said originally, if you're in this for 5, 10, 15 years, it's going to be a good entity. It's going to be, you're not going to lose money on property values, and rental is going to go up, and so on and so on. The first time buyer market, like I mentioned earlier on, is struggling, even with the new 95% that are out there. Not every lender can afford to do a 95% mortgage. So there's a few that are doing them at the moment, which are great to get certain people on the market, but actually still, while first time buyers still struggle to get on the ladder, whilst we come to the end of furlough, we're going to see a lot more people, unfortunately, that will lose their jobs and so on. You know, there's going to be an ongoing problem for a good number of years yet until we actually get back to a decent entity, and possibly, you know, will we ever get back to where we were two years ago, which when, you know, the whole market was completely flying. But that's the morbid side of it. The reality, and right now, like I said, 12 months ago, we would never predict that we were in such a positive entity right now, with lenders wanting to lend, rents going great. You know, the market is very, very buoyant at the moment. So 5 years' time, I can't really see too much happening with the Bank of England base rate. I think the mortgage lenders, you know, they are all in a price war currently. So I think that's going to increase over the next year or so as well. And I think it's probably a good time right now to, if you're still sitting on a standard variable rate, then, you know, why why wait? Do something now. Rates are really, really good, and you don't be loyal to your lender, because, you know, the bottom line is they probably haven't been loyal to you over the last couple of years. So look out for number one, make sure you're on the best rate possible, and speak to someone in the industry who can help you get to the right scenario.
Okay, great, thank you. Martijn?
Yeah, I think the UK market has been probably wonderful for 20 years now. So it is sort of classic investment theory wise. You'd expect it to be lower risk and lower return than stocks, and that is typically across the entire cycle. That means it's a 5 to 6% all-in return. We've had much higher in the last few years, although you've got to be honest with yourself in your business plans about the costs. If there's a one-off that returns every 2 years, it's going to be a one-off. And I think there's one more shock coming. They talked about it. I think the upgrade to EPC rating is massively underestimated in the UK market. So I think there's a lot of investment that should go there. And on a personal note, I think it would be great if we reduce that huge source of emissions together. So gradually going through that, and every time you do a bit of an upgrade, make sure it's green is wise from a business and planet sense. So I think with that, that is a realistic assumption, and I think it looks like that is also very doable on the average property. Make sure your individual selection is correct for both tenant and property, but there is it's a pretty stable market as it has been. And the biggest shock we could have seen has just happened last year, and we're still standing quite strong. So I'm feeling that it's a good outlook for the medium term.
Okay, thank you. And Kate, over to you. I mean, actually, one thing alongside that as well, I was interested when Martijn was talking about rental yields in inner cities as well. I'm keen to get your views on. I thought rentals were going down in the cities. Is there still a demand? Will it continue, or will it come back as well?
Yeah, I think there's been a lot of over egging of the people moving out, etc. And Home Track did come out. I always look to see if there's somebody with some massive data capacity that might even slightly back what I'm doing or what I'm saying, and they did. And I actually looked at people moving September, October, November last year in the land registry transactions, and compared it to the previous year. And there wasn't a massive percentage increase going to Wales or anywhere else, or a big drop in London or anything. And in fact, the Southeast was the only one that actually rose a little bit. So whether the data's a bit behind. So whether we'll start seeing data now, there was a news story about sort of Devon and Cornwall and everybody sort of running there. I still think they're quite parochial stories. And I do not believe that the city is dead by any stretch of the imagination. I do think more people will commute, but I think we're 2 or 3 years away from that, because we're not going to know till this time next year how many, and companies aren't going to know how they can run their businesses in this new normal that we're going to head towards. So everybody might say, oh, I want to stay at home. I want to stay at home. Get back to the office and go, I don't want to stay at home anymore. We don't know how people are going to react. So I think there will be some movement. But do you know what? We've just got to remember that in a lot of places, I think the Northeast is the only one, and particularly in London, when you look at the population increases that they're expecting, and that's what drives all of this. So if you want to know what's going to happen in Manchester, in Nottingham, in Lambeth, for example, go look at the population increase stats for that area, and then look at how many houses they're predicting they're gonna build. And if the population is a lot higher than the number of properties they're going to build, then you've got to have that supply and demand restriction. And that's a kind of overall way of looking at an area. And then you've got to dig down into the property on a street. But if you get a really good property on a really good street, where the demand is always going to be higher than supply, you will always drive those capital growth, and you'll always have a good rental market, even if it just washes its face, or it's a good rental market and the capital growth isn't there. You'll get one or the other over the next 5 or 10 years. And I think people haven't quite realised. It's been going on since 2005, and I still don't think people have realised the numbers yet. And you look at that, the Northeast is a classic example. People still running from London up to the Northeast. Complete and utter madness, potentially, unless they really know how to go and buy a good deal and build in the capital growth from the start. So I think we're going to see a lot of change in the way that of landlords over the next 5 years. And I think there will be better landlords and better property investors. And I think that's a good thing for the market. But you can only see demand going up in most areas. And the only areas where that won't influence is prices and rents going upwards is where they're doing a very, very good job of building the number of houses behind it, like Manchester, for example. And the other thing I think we forget in the rental market is I'm seriously shocked about the build to rent market and the super prime market, which we hardly, I don't kind of talk about it because it's so specialist, but there's massive growth in those markets. People paying £8,000 a week to rent properties. I mean, to me, it's kind of utter madness, but that's what people are doing. So I think we just really underestimate the fact that the private rental sector is here to stay. The government cannot smash it. They just can't, unless they go and build 1 million social homes yesterday, which they can't do. So it's got to still thrive into the future. And until eventually somebody will realize that they can't influence, stop people from renting privately. It's just not possible. So I think the future is bright, but I think it's very much down to an individual property in an individual area. And that's, the examples I think that Dale was putting up were excellent, because that's what it's all about. If you want to be successful, you've got to make sure that that individual deal stacks up now and stacks up in 20 years' time.
Thank you very much. We've spoken about property valuation, property prices and growth and bouncing back, but what's your view in terms of valuations? There was a question that was suggesting that people are dampening and being very conservative with valuations. So I'd be interested to get your views, all of you, on what we're seeing in terms of actual valuations versus prices. Dale?
First, yeah. I haven't seen it, to be honest, and we're doing a lot of valuations every single day, or instructing valuations every single day. So I'm not seeing the down valuations as such. What we are seeing is that valuers at the moment are obviously very skeptical about what's going to happen with house prices. So they're actually taking probably a little bit longer to do their normal research and comparisons and so on of that area. And what we're also seeing, of course, is, people have had the virus, they've been off. So you might have 2 or 3 valuers in a certain area who have all been hit and struck down and are in confinement on that basis, isolation on that basis. And someone's had to come in from another area to cover their patch. And of course, they don't know that area. So they're taking a little bit longer, and maybe they're a little bit more hesitant to actually put, a price on a property. They're not so researched on that area, or they don't live in that area. So I wouldn't say that lenders are forcing the valuers to down value, because we're not seeing that, but I do think they're all covering their backs at the moment because they don't want to be hit in a couple of years' time if there is a crash, which I don't believe there will be. But they're just being a little bit more skeptical and hesitant with regards to actually putting a price on a property right now, and that includes putting a price on the rental as well, because they don't know what's happening in certain areas. So I would just say, just be wary that they've got a job to do and they've got insurance that covers them. And therefore, they're going to do everything they can to make sure they get that figure correct on the valuation of that property.
Okay. Martijn, do you, from a lender perspective and a broker?
Yeah, that makes sense. Having worked at a few big lenders, I doubt that the lenders putting pressure on the valuer to down value. I think it's values have been a bit conservative in the past when there's been a shift in economic cycle. We're seeing some of it, but not that much. There is a bit of pressure on, and I think there's very limited flexibility on what is known as comparable. So valuer needs to not just give a number, but say to the lender typically, these are the 3 properties that were recently sold close by the property we're talking about, and that is why I think it's worth X. And I think the flexibility to say, well, this one was 50 kilometers away, but I think it's okay, or it was sold 3 years ago, but I think it's okay. I think that flexibility may be tighter. So there's which was a conundrum last year. As there's been a bit more volume over the last 4 months, I think that problem has gone away a bit. So I was worried about down valuation in September, but not so much now.
Okay, thank you. And Kate, from your perspective?
Yeah, I think you do have to understand these guys do have rules. They can't just invent what they're going to value something out and then go, and I'll knock it down by 10%. I'm fairly sure that's a kind of myth that gets perpetuated because it suits people, or it's how they feel that that's what they feel's done. But I think you're right. I think actually the comparables are incredibly difficult to get a hold of, and the less, although we've had a big rate of sale over the last 12 months, we haven't in previous years, and therefore it is very, very difficult to price properties. We do comparables all the time, and sometimes it's like, oh, this is an impossible one, and it's kind of like a nice game for us. It's what I would do instead of playing on a PlayStation or something, if they still exist. So I think just kind of don't believe the hype on this, really. And lenders aren't saying to you, you must downvalue everything by 10% because we think that's the best thing to do. This stuff is not really happening behind the scenes, as far as I'm aware, unless I'm extraordinarily naive in my approach. So trust your surveyor, because there will be good reason if they are saying that it's not worth what it is. They either haven't got the comparables to give anything else, or there is a particular reason, and you've got to find out what that is, rather than just thinking, oh, they've just downvalued it because that's what they do. So just sort of take what you hear with a bit of a pinch of salt, I think.
Okay, thank you. I'm going to move to the final question, I think, now, and one that's just come in terms, you were talking about EPC ratings and upgrading properties, and I think the question had come in kind of talking about the Green Deal that was kind of scrapped this week, and what future government kind of scheme support you see, and what kind of timescale you kind of see that happening in. Kate, do you want to go first?
Yes, so there's a consultation out at the moment, and I think we're going to have to wait to see what the results of that are first. It's whether the EPC, whether to rent a property at an EPC rating of C gets brought forward to 2025. I think that's for new tenancies. Shout if I'm wrong, if anybody knows any different. And then for existing tenancies in 2028. And that's being brought forward from 2028, if I've got that right. So Valerie will probably know. So shout Valerie if I've got that wrong. So I think what we're going to have to wait and see is the result of the consultation for that. There is obviously, I don't know why they can't get it right, but obviously the Green Deal was a massive failure. And now they've just pulled the grant, the grant that was just, I mean, goodness me, it's only been out since September. How do you manage to mess something up like this in such a short space of time is quite, it's quite astonishing. And how we can do an amazing vaccination program and completely mess this up for our futures is beyond me, to be honest. So there may well be some things coming in, but I'm going to be really honest with you. As a landlord, don't expect any favors. What you've got to look at this is an investment in your property asset to get the energy rating up. And the better you do that, the more likely is that your tenant is going to pay the rent. And that's the way that I would look at it. And I do think, I know about 10, 15 years ago, there was lots of talk and forecasts of if you improved your energy efficiency by this, your house would be worth X amount more. None of that has come to fruition yet. And I think that's because it takes a lot longer. So I think we're probably another 5 or 10 years ahead. But in buy-to-let terms, that's nothing. So don't rely on anybody else. Get it done yourself. I think you'll get it. I don't know how Martijn, Dale feel about it, but I think eventually you'll get it back in the value of your property, or the ability to be able to rent it a lot quicker, have less voids, etc. And that's my view. So just get it done. It makes good business sense. Is how I look at it. Okay,
and Martijn and Dale, really, from a lending perspective, is there anything lenders are doing or can do to help landlords with improving the rating on their property or financing?
I think there's a couple of lenders that are trying to do quite good incentives, and we've seen them over the last few months. And I can't recall exactly off the top of my head, but there are certain lenders that, if you improve your EPC rating, one of them was given £1,000 cash back on the mortgage side. So there are. I'm not sure if that's still available, by the way, but it was definitely out there at some point. And I think over the last couple of days, I've seen a buy-to-let lender come out that are looking to really incentivize landlords for certain EPCs. I think it might have been C and above. I can't recall the exact details, but there are lenders looking at doing effectively green mortgages and also incentivizing you at the same time. So again, speak to, have a look around, do your homework, and speak to the specialists.
Yeah, I think that makes perfect sense. In the sort of medium term, I think the government has sort of two weapons. So I think there'll be a new grant type thing coming up in the run-up to the Glasgow conference about climate. There's bound to be something, but I think sort of a cautionary tale is from my country. I'm Dutch, where it's forbidden by law to you can't get a buy-to-let mortgage if the underlying property has a rating that is not high enough. Now that is a much more socialist country, and it also has newer properties. So I'm not sure, but the government could choose to wield a stick rather than just add carrots in the next few years. On the more positive side, there is quite a lot of movement on the capital markets to make green financing cheaper than normal financing. So I can see the excellent examples Dale mentioned. I think there's going to be more things coming where the rate is lower if you have a rating of X, or it's easier to get a further advance if you improve it by more than 2 notches. I can see that coming, not in the next year or so. I think it's going to be pilot stage for now, but that's inevitable. The question is just how fast can we get there.
Great. Okay. Well, thank you very much. I immensely enjoyed speaking to you all. I hope that obviously I've managed to cover many of the questions that were put to us, either through the presentations or in the session. We are obviously going to make the recording of this available within the next week, both on our YouTube channel, but also with a link to Facebook. And Habito also sends out a buy-to-let newsletter. The next, we're doing these events now on a quarterly basis, so date for your diary to book in is Tuesday the 29th of June, where we'll be hosting the next of these. But yeah, it just leaves me to say thank you once again to all our panelists for all their excellent insight and knowledge. Thank you once again, Dale, Kate and Martijn. And thank you for all of those who stayed with us. I can see there's quite a few of us. I know we've overrun, but hopefully. Sorry.
There was no we involved, let's all be very honest.
I was sparing your blushes, but no, it's fine.
It is what it is.
No, it was great stuff. So thank you to you all. Have a good evening. Take care, and we'll see you again soon.